Welcome to DeFi Crypto today. Our topic today is Unslashed, the insurance for decentralized finance. All right, a lot of people have been asking me about insurance and how to protect their assets and so on. So we're going to start looking at some insurance products for DeFi. Now, this one you can use for several projects, but one of the main projects where you can buy it for, okay, is Anchor. I've done several videos about Anchor. The links are all in the description below. So if you don't know what Anchor is, please watch the other videos. But basically, one of the main features of Anchor, and it's a massive project, as we can see, it's got $11 billion in there. We can earn a very juicy 19.5% APY on our stablecoin UST. It's one of the best places at the moment if you want to have a pretty stable rate of return on stable coins. So the UST basically is worth about $1. And on Anchor, the rates since June have been always over 19%. Always very, very close to 19.5. Currently, it's by accident, it's exactly 19.5. But sometimes a little bit less, sometimes a little bit more. It can go up and down a little bit, but typically I haven't seen it yet under 19%. So if you want to have a very predictable income on stablecoins, that's a good place to do that. Basically, you can use this as a savings account that gives you a very generous 19.5%, and you don't need to worry about it too much. Now, that being said, some people have massive amounts of liquidity that they want to deposit on Anchor. And so, for instance, if you got 100,000 or $500,000 and you want to earn 19.5%, okay, Anchor is nice. It's been audited and all that. It's been pretty solid. But you might feel a little bit worried. What if a hacker goes in there and messes up the system? What if the UST goes off peg and it goes, below the value of $1, okay, by a wide margin? Typically, UST is going to stay very, very, very close to $1, okay? But sometimes in extreme market conditions, you might expect that the UST token is going to go off peg and drop suddenly, okay? And if that happens, you might lose some money. So in those circumstances, you might want to protect your deposit. That feature is right here. And if you click on that, it's going to bring you to Unslashed. Okay? Now, you have to be very, very clear. Insurance does not protect you against every conceivable risk. Now, we're talking about UST, which is a stable coin, okay? In this case, the Unslash does protect you against UST going off peg, okay? So if the value of UST strays away too far from $1, it will protect you. It will also protect you if a hacker goes into that system and steals the money. But you can also there's several tokens that can be insured on Slash. Okay, for instance, the Olympus Ohm token can be insured. They're not going to insure against the price of the Ohm token going down. Okay, if the price of the Ohm token is, let's say, I don't know what the price is right now, I didn't check, but let's say it's $500, okay? And you paid $500 today for that. And I don't know, the market crashes tomorrow and the price of the token drops to $200. So you lost $300. Unslash not going to pay you back that $300 that you lost. You have to bite the bullet. Okay? Normal market fluctuations are not covered by any insurance product ever on the planet. Nobody insures against that. That would be stupid because that's normal. Markets, are depend on the market price depends on supply and demand. If people hate Olympus Dow suddenly, they're gonna make the price of the token tank. If they love it, they're gonna make the price of the token rise, and that's normal. It happens for every financial product. It happens for stocks. It happens for tokens. It happens for gold. It happens for everything. Make sure that's clear. Insurance is not going to protect you against market fluctuations. So there's no point in buying that for to protect against that. All right. Now you have two things you can do on Unslashed. You can either get insured or you can earn yield by providing funds that are going to be used to pay claims. So these are the types of risks that Unslashed protects against. We're going to have a quick look at this. There's a lot of stuff here. So exchange hacks. So you can have an exchange like Binance, Coinbase, or even, I think they also do decentralized exchanges. And they can protect against hackers going into their system. So if people lose money due to hacking into Binance, Coinbase, or whatever, and the insurance will pay. Smart contract failures. All of DeFi is running on smart contracts. Smart contracts are programs, they're code, and they're made by human beings, which are not perfect. So they make mistakes from time to time. Okay? If market conditions happen that are not anticipated by the programmers, the program can go haywire and you lose money. Okay, the program can respond in a way that's not anticipated and make people lose money. So you can have insurance to protect against errors in the smart contract. When the smart contract fails, this insurance can pay for that in some conditions. Okay. Oracle malfunctions. An oracle is a system that tells the price of a token, and it's relied upon by thousands of DeFi projects. Okay, Chainlink, for instance, is an oracle that's very widely used. If the oracle used by the protocol fails, that can be covered as well. Wallet exploits. There are wallets on exchanges. If those wallets are exploited, or if you have a ledger wallet, okay, in some conditions, okay, in some situations, that can be covered if they are exploited. In some cases, read the fine print of the contract. Okay, I'm going to show you an example of a contract. I'm not going to go specifically into this exploit because it's getting complicated, and we don't want a 3-hour video about insurance. Then you have custody risks. Okay, so places that hold your funds for you, like exchanges. Okay, they can have some custody risks. Stablecoin pegs, we just talked about that with UST. If the price of the stablecoin goes off peg and it's having trouble coming back to peg, you're losing money, and the insurance could cover you here. Validators slashing. Validators are the people that validate transactions on the blockchain. So if they slash, okay, if they make mistakes on purpose or not, okay, that could be covered as well. Now, they have what they call the Spartan bucket. We have a quick look at that. Okay, that's essentially for people that want to earn yield. Okay, they can provide funds in the bucket and help the insurance system have money in reserve to pay off claims. And they give you a juicy reward in exchange. They provide insurance for DAO, for protocols, DAOs, and institutions as well. So we've got examples of protocols and projects that they insure here. You can participate in the community, you can earn yield. If you're a developer, you can work there, and you can join the DAO. Again, I have to explain this because people get confused. A DAO is a decentralized autonomous organization, has nothing to do with Olympus DAO. Olympus DAO happens to be a decentralized autonomous organization, but they're not related in any other way. This DAO provides insurance products. That's it. Has nothing else to do with Olympus. Okay, nothing. All right. They have a world-class team and with faces and everything. Uh, so it's real people behind this, and amazingly, okay. And they have several people in their team, and they're all like great programmers and engineers and so on. They've been audited. They have all kinds of big companies using their products, like Citibank here we can see, and a bunch of other people. All right, so let's look inside. Okay, this is the Spartan bucket. So you could supply capital here. Now, word of warning, it's on Ethereum. Although Anchor is on the Terra ecosystem, the insurance products have to be bought, or you can invest in this bucket, for instance, on the Ethereum network only. Okay, so be prepared for high gas fees. So my advice is that if you've got a tiny portfolio of like $1,000 to $3,000, it's not for you. Okay, we're talking large portfolios here. I don't think it's even conceivable for a portfolio of less than $50,000. Okay, personally, I would think that if you've got 100 grand that you want to insure or more, that's probably a good enough for this kind of project. Okay, because you got to consider the premium that you have to pay also. Okay, insurance not free. They're going to charge you a premium, a certain percentage. We're going to see that in a moment. Right now, we're looking at supplying capital. So if you want to earn a yield, okay, by investing in the insurance DeFi project, okay, you can do that. Right now, for instance, this is a little, the Spartan bucket basically is a portfolio, okay? These are projects that are being insured by Unslashed, okay? And they put 2 point something percent or whatever percentage for each project. Okay, so it's quite diversified. So if and you've got Olympus here, you've got the UST peg, you've got Anchor that we're familiar with. So let's say something bad, really bad happens at Anchor. Well, it's only 2.7% of this portfolio. So if this fails, the rest should be okay. All right, they're not that much linked to each other, except maybe the UST peg. These two might be correlated somehow. But again, that the total is about 5%. So it's only 5% of the entire portfolio. Okay, so if you're looking for a diversified portfolio to invest into, that might be something to consider. Okay, and also you have to understand that the insurance business is risk averse. So they're only going to insure the best possible projects with the lowest possible risks. They're not going to insure like the latest Olympus fork that just came out yesterday, okay? Because the risk there is nearly 100%. They're almost 100% sure you're going to lose your money on that. Here, They are investing in the safest possible project, and they're only insuring the things that are the least likely to break. You gotta understand how insurance works, okay? Insurance is basically giving you safety for the things that are probably never going to happen or very unlikely, okay? But still, if you have a mega portfolio, okay, if you got millions and millions and millions, you want insurance just in case something insane happen. If you don't think about that when you've got like hundreds of thousands of dollars to invest or millions of dollars to invest, the unthinkable can happen. Okay, and that's why they have these insurance products. Okay, just to give you extra safety. Okay, because even if it's very unlikely that Anchor breaks, okay, that the smart contracts at Anchor breaks or that the UST it goes off peg, it still can happen. It still can happen. And if it happens and you lose a lot of money, you're not going to be very happy. That's for those people, insurance matters, okay? And you need to think about getting a good insurance policy and possibly at Unslashed. Okay. Now, for investors, these would be pretty safe as well. Okay, because these are probably some of the best DeFi protocols around. Because insurers want safety. So if you're looking for an investment that gives you what is it now? 13%? Is it? Yeah, 13%. You're getting a 13% APY here, which is quite nice. And you're doing it by providing funds to the insurer, who is only insuring the best possible DeFi projects that exist on the planet right now. The chances that all of them are going to fail at the same time are nil. So you can bet that your 13% there is probably pretty safe. It will fluctuate. Nothing is fixed in the universe of crypto. But your assets are pretty safe. Okay, your deposits should be pretty safe. All right, enough about this Spartan bucket. You could also invest in pools individually. Okay, that's also possible, but we're not going to delve into this right now. Let's have a look at buying insurance now. What can we buy? These are all the projects that are available to that can be protected using insurance. Now, make sure that you read the fine print because it's different from project to project. First of all, as you can see here, the premium here is only 1.9995%. Here it's 4.41%. Here it's 1.0%. So the rates change quite a bit here, 3 point something percent. Now think about this. If you're investing at Anchor, for instance, you're getting 18.5%, but you have to pay a premium of 7.87. So that cuts your yield quite a bit. And that's why I'm saying it's not for the small portfolios, okay? So basically, when you see a high premium like this, that's because the insurer thinks there's more risk. Here they consider this less risk. And this one even less risk. And this one is even less risk at Compound. Why? Compound's been around forever. It's one of the very first DeFi projects that have been around, and there's like gazillion dollars in there. Okay, so you have to be aware of this before you decide to take the insurance. Okay, and again, it's not going to protect you against every conceivable way you can lose money. Okay, read the fine print, read the documentation. They've got a lot of documentation on this website. And if that's not enough and you still have questions, well, as we're going to see in the contract here, this is the contract for Terra Anchor UST insurance. Okay, we're going to have a quick look at this. I'm not going to read every single line here. But okay, this as it says here, they're covering the dollar peg stability for UST and the Anchor Protocol smart contracts. Only. That's it. That's all they cover. If you get your wallet hacked, they're not covering that. If you lose your wallet password or secret phrase, they don't cover that either. Make sure that's clear before you buy these products. They don't cover every possible way you can lose money. Okay, they cover only the peg for UST. So if UST goes off the dollar peg, they cover that. If Anchor Protocol smart contracts break, because I don't know, a gazillion people decide to withdraw at the same time or deposit at the same time or whatever, and the code can't handle the pressure and it breaks and you lose money, okay, the contract, the insurance pays for it. That's it. That's about it. Doesn't cover every eventuality. All right. Now, if you're not sure and you don't quite understand all the verbiage in the contract, they say feel free to contact us. If you have any questions, we'll be happy to help. Let's go. They're happy to help. So call them, send them an email or whatever. Okay, contact them if you don't understand the contract. Don't ask me. I didn't write the contract. I'm just showing you the contracts, trying to explain to you a little bit about them. All right, what is insured? Any wallet address which contains the insurance token Terra Anchor UST issued by the smart contract address. Okay, so when you buy the insurance, basically you're paying for this token, and that's going to go into your wallet address on MetaMask. All right, on the Ethereum network, and you have to make sure you're using this contract address for that token. If you don't have that token in your MetaMask, you're not getting insured. That's what's important here. The only thing that's insured is the wallet address that contains this. Clear? All right. So you can read those little details later. Okay, they explain what's covered. UST is stablecoin pegged to the US dollar. It happens that UST trades above or below the peg, in which case it results in losses. Anchor Protocol is a smart contract network on the Terra blockchain. Smart contract networks can be the target of hacks or exploits which result in losses. So they cover that. Your claim will be accepted under this policy if the loss is related to UST, US dollar peg, US trading below 0.087 on CMC, CoinGecko, or other reputable sources. The loss of UST, US dollar peg results from a TWAP based on market data extracted from reputable sources below $0.87 in a 2-week span at least, and the loss occurred during the policy period. The policy period is the time when you have this token in your wallet. Okay, there's also, was it 10 days? There's a period where you're going to have to hold the token and wait until you make a claim. If anything happens during that waiting period, they don't care. Okay. So this is one case. The other case, or it says, the loss is related to the smart contract network described in the appendix, and the loss occurred due to an unauthorized, malicious, or criminal act aiming at exploiting covered smart contract code vulnerabilities, and or loss occurred due to errors and omissions in code implementation, or unavailability or failure to access or process these covered smart contracts, and the loss occurred during the policy period. So if the smart contracts at Anchor fail, according to this, you're covered during the policy period. What is the policy period? I'm glad you asked. The policy begins after an initial waiting period of 10 days that start as soon as the insurance token related to this contract address is in the insured wallet. All right. So you buy the insurance. Okay. You're getting this token in your wallet. You have to wait 10 days. After that 10-day period, your policy starts. So during the first 10 days, pray to God, okay, that nothing bad happens to the UST peg or the Anchor protocol smart contracts because you're not covered. Okay? You only get covered after the 10-day waiting period. Make sure that's clear before you do any of this. And the insurance period, the policy period stays in effect for as long as you have the token in your wallet. So whatever, you buy the tokens today, and you leave it there for 2-3 years, that should cover you during that period. Then they say users are encouraged to rebalance their cover as the ETH price might vary over time. Yeah, you're paying always in ETH and Ethereum tokens, okay, your insurance. And that's why I said this is all on the Ethereum network, okay? So if you hate gas fees, too bad, you can't get it. You need to pay the big gas fees on the big boy Ethereum network, okay? This is for big boy portfolios, big boy and big girl portfolios, okay? All right. So it doesn't work on no stinking Avalanche, Polygon, or Binance Smart Chain. All right. So you have to rebalance if the price of Ethereum tanks or whatever, you're not going to be covered as well. Okay, so you need to deposit more ETH if you want to get enough coverage. All right. They say regular rebalancing is defined as happening every 2 to 4 weeks. So check your coverage every 2 to 4 weeks to make sure that you have enough coverage. Okay, the policy ends as soon as the insured wallet does not contain the aforementioned insurance token anymore. So as soon as you lose the token, you sell it or whatever you do with it, if it's not in that wallet, it's gone. You don't have an insurance policy anymore. The insurance policy is terminated. How much is covered? Depends on the quantity of insurance tokens the insured wallet holds. As clearly specified, quantity of tokens matches a definite amount of Ether that falls under our coverage. The ratio between the quantity of token and the covered amount changes every cycle, according to formula described in the documentation. So read the documentation if you want to know. Okay. The length of one cycle is 30 days, starting from the end of the previous cycle. The first cycle started at the contract's deployment. Please check our covered amount and rollover date of cycle for your user interface. So you need to check all this stuff. Again, insurance like this is for large portfolios. Okay. So if you want to reduce your risk, read the fine print, understand what's covered, understand how the coverage works, understand if you need to rebalance your Ethereum deposit and to pay your premium and all that stuff. Okay. All right. How much premium do I pay? The premium you'll pay is determined algorithmically and depends on supply and demand for this policy, always varying between the minimum price and maximum price. Minimum price is a percentage of the sum that is covered in Ethereum. The minimum premium price is set to 1% per year and the maximum premium price around 15% per year. A target fair pricing range for this policy is defined as between 4% and 4.5% per year. So that gives you an idea. Okay. Do I need to submit a claim? Yes, you need to submit a claim, otherwise I'm not going to pay you. So if you lose money during the insurance period, there's a button that you can see. Like let's say we go on this one, right? We're not connected. Change for Ethereum. Now we're connected. All right. So let's say we want to anchor UST peg. Okay. This is where you would deposit you can add your ETH to pay the premium. And this button here, file a claim, is, well, right now I'm not covered for anything, which is normal because I'm not. But you click on that button and you fill up the form and you explain what you lost, how it happened, and so on and so forth. Okay. All right, so you have to submit a claim. It's not automatic. They don't know when you lose anything. You have to tell them. And then they verify. Okay. So it says you are required to provide us with truthful pieces of information. Otherwise, your claim will be rejected. So if you lie, they're not going to pay you. All right. Are there any exclusions? Yeah. If it's a virus, a phishing attack, a hack of other malicious activity with UST and Anchor Protocol smart contracts on the Terra blockchain continue to behave as intended, an external bridge smart contract being hacked, for instance, you're not going to get paid. If the system works normally and you got hacked and you lost money, but Anchor is still working fine and the UST did not lose its peg, okay, but you lost your UST because somebody put a computer virus on your computer or something, forget it. They're not going to pay you. It's related to a hack smart contract network for which a hack or bug has been made public before the beginning of the policy period. So if Anchor says, okay, we have our smart contract has been hacked, or we found a bug in the smart contract, and they publish that before you buy the insurance policy, it's not covered. Okay, because it's a known problem. Why are they doing this? Well, because some smart ass is going to think, oh, I know about this problem there, and then I'm going to claim that I lost money and the insurance is going to pay. No, they're not going to pay. Okay, it's related to an attack vector which was communicated by any official documentation. It's kind of the same. It's a known problem. They're not paying for known problems. It's related to a smart contract or set of smart contracts which was generated for the sole purpose of submitting a claim and getting cover and not to be used by other users. So if you created a smart contract to try to receive claims and to get cover, underhandedly, they're not paying. Okay, and they say here, we're almost done. Okay, admissions, arbitration. This is kind of neat. I just discovered that. I didn't even know this existed until I read the contract. You can get arbitration. Decentralized. There's a decentralized court. Can you believe it? So they say here, we do our utmost to provide you with the insurance you need. The claim process is supervised by Kleros, the world's first decentralized court. Isn't that amazing? Kleros is a trustless dispute resolution system that guarantees security, fairness, and transparency. It's really neat. I had a quick look at Kleros' website today. Basically, what it is that it's an open, decentralized court. Anybody on the planet can become a juror at Kleros and get paid, render decisions on court cases. Isn't that neat? So you could become a professional juror and get paid, okay? And you decide the fate of the universe and the crypto world, and they pay you for it. Isn't that nice? Yeah, I might make a video about this. It's really cool. Well, now we're done. Thanks. Anyway, so you have in the appendix here, they tell you which contracts are valid for the insurance and all that stuff. So anyway, remember, if you have and this is mostly for people with large portfolios, okay? I don't think it's worth the trouble if you have a lot less than 100,000 in your portfolio that you want to protect in this case, in this policy, at Anchor What, for instance. Not Anchor What. What am I saying? At Anchor Protocol. Anchor What? I'm too close to Cambodia. Anyway. No, if you have over 100 grand at Anchor Protocol, probably you should consider insurance. Although they charge a very fat premium. So that's going to cut into your APY. At Anchor right now, you're getting 19.5%. They're going to charge you 7 point something percent insurance on this. Okay. So up to you to decide if that's worth the trouble or not. Okay. But if you feel very, very insecure and you've got a ton of money at Anchor, maybe that's a solution for you. Okay. They have, as we saw, they have several markets for several products. Get covered here. All right. So if you are invested in any of these projects and the premium is not too crazy, that might be something to consider. Okay. So you have about 40 odd different projects here. All right. So check it out. Now, don't forget, like for instance, let's say you want to protect your Olympus own tokens. They're not going to protect you against price fluctuations. Here, it's smart contract integrity. Okay, and that's why Olympus has been audited many times, because they want to protect the code. Okay, if the code has bugs, or if somebody hacks into the code, that's covered. If the price of Olympus down drops 90% and you lost 90% of your asset that you invested at Olympus Dow, I'm sorry, but that's not covered. There's nothing to cover that. Okay, it doesn't exist. All right, so that's it for this video. If you like this kind of stuff, please like and subscribe. Don't forget to ring the bell. Download the free book, and it's free. All you have to do is type your name, your email address, hit the submit button. You got a big fat button that says download the free book. And if you miss that, we're sending you an email with another button that says download the free book. And if you don't want the free book, go to Amazon, pay $5.99 to Jeff Bezos, and Jeff will send me a whole $1. See you.